Hi, everybody. My name is Jay Scalen, and I'm a member of our investment team here at Osborne Partners. And I'm excited to have the opportunity today to talk about an important asset class, and that's foreign equities. And what I'd like to do is take a quick look back at 2022, as well as share some of our team's thoughts on what may transpire in the new year in 2023. Now, any way you slice it, 2022 was an incredibly challenging year. And investors were not able to find any relief outside the US, where they really faced a multitude of headwinds, including rapidly escalating geopolitical tensions, a dramatic increase in interest rates across the globe in response to multi-decade highs in inflation, as well as concerns around the possibility of a global recession. Now, the beginning of 2022 was marked by the shocking news that Russia had invaded the Ukraine. And this news soon morphed into concerns around the possibility of China invading Taiwan. And the market impact of these events was meaningful, with European equities down over 30% and Chinese equities down over 40% at their lows in the fall. But maybe the biggest topic for markets in 2022 was the dramatic increase in inflation really across the world, and the equally dramatic response that we saw from central banks in the form of massive rate increases. For many central banks around the world, this marked the most aggressive rate hike cycle in history. Now, the impact of the previous events culminated in the form of increasing concerns around the possibility of a global recession. And the chart on this slide shows forecasted economic growth for 2022 in purple and 2023 in green for Europe, which, as you can see, clearly took a step down in the second half of the year. Okay, so what does this mean for 2023? If you look back at history, and as this chart depicts, US equities and foreign equities have seen alternating stretches of relative outperformance over the past 50 plus years. And while foreign equities were down last year, it was also the first year since 2017 they outperformed US equities. And what I'd like to do is spend the majority of this video highlighting some of the reasons that our team thinks that this recent stretch of outperformance can continue. The first reason is valuations. Almost any way you slice it, valuations in foreign equity markets are intriguing. As you can see from the chart on the left, the broad MSCI All Country World ex-US index is hovering around a 30% discount to their US peers, which is near 2 full standard deviations below its norm. Chinese equity valuations are even more compelling. Towards the end of last year, Chinese equities hit their lowest valuations in over a decade. And even after the recent sharp rally that we've seen, they still appear attractive. Two other variables that were material headwinds last year that could shift to tailwinds this year are sentiment around foreign equities and FX, or foreign exchange. Now, there's many ways to measure investor sentiment. The chart on the top looks at the amount of money that has been flowing into the US and various foreign equity markets in recent years. And as you can see, investors have largely shunned foreign markets. If this reverses, as it usually does when performance shifts, this could be a very powerful tailwind for foreign equities. Another tailwind could come in the form of a softer US dollar. After hitting nearly 20-year highs late last year, the dollar has pulled back in recent months. And our team believes that in 2023, it'll be another soft year for the dollar, which should help performance in foreign equity markets. One of the most highly debated topics is how to think about earnings growth in 2023. Now, at the moment, projected growth for foreign equity markets at large is right around 0%, with the debate mostly focused on how much lower estimates can go from here. Fortunately, our team is able to identify and selectively overweight specific countries or specific regions that we find more compelling when looking at variables like the quality of underlying holdings, valuations, and earnings growth. And the result of that approach is that our 3 largest overweighted regions happen to be China, the Netherlands, and India, who are expected to grow earnings anywhere from 14% to 21% in 2023. Now, the last topic that we believe should result in a more favorable backdrop for this asset class in 2023 is inflation and interest rates. Now, we talked about inflation reaching multi-decade highs last year. And as you can see from the chart on the left, we're now in the midst of a broad-based cool down across most categories, meaning we should see inflation ratings decline meaningfully throughout 2023. The result of that is that major central banks should soon slow and then ultimately stop rate hikes. And this dynamic should be well received by markets who have really been confronted with nothing but dramatic interest rate increases for the past 12 plus months. Like we said, it was difficult at times last year to remain optimistic given the wide variety of headwinds that markets were facing. But 2023 is a new year with its own unique dynamics. And to recap some of the reasons our team is optimistic, really around several asset classes, but specifically foreign equities. First, valuations are meaningfully discounted on an absolute and a relative basis. Second, investors are underallocated to foreign equity markets, and any incremental flows to this asset class should provide support. The next reason revolves around the US dollar and our belief that it will soften this year, which should help foreign returns. The fourth reason is that inflation and rate dynamics shift from both rapidly increasing in 2022 to both gradually cooling or decreasing this year. And then lastly, and more specific to our positioning, being exposed to specific countries or regions that are expected to see superior growth should aid overall performance. We want to thank you for taking the time to watch this short video. We all know that 2022 was an incredibly challenging year on many fronts, but we do believe there are reasons to be optimistic as we look ahead to 2023. Thank you very much, and please keep an eye out for additional Outlook videos on other asset classes in the weeks ahead.